Hey, Tanya, thanks very much, and welcome everyone to the webinar this morning. We've been doing a few of these across Canada and in Atlantic Canada. The way that generally we feel it's best to structure them is we're just going to go through and do a bit of a Q&A. I've got three partners here with me on the panel this morning. First, I'll introduce Katie Rogers, who is our Atlantic tax leader and resident here in St. John, New Brunswick. Brian Stavine, who's our Canadian working capital leader, and he spent lots of time in Atlantic Canada and in New Brunswick, so he's very familiar with a lot of the business community that we have here, and presented with the Moncton Chamber a couple weeks ago as well. And Derek Dempster, who's our Atlantic leader for Deloitte private side of the business. And so the three of them will discuss with me this morning some of the impacts of COVID-19 on business and some of the things that the businesses can do to better prepare. So maybe just with a couple of overriding comments, then I'll get into the questions. Really, the way that we've been thinking of the crisis is to cut it up into three pieces. So one is respond, two is recover, and three is thrive. And that's essentially the three phases with which we would plan and design our responses and things like that. So the respond, you can think of it, that's when a company deals with the present situation and manages continuity. So that's like the immediate term. Most businesses are still in this respond or react phase right now. The second, though, will be recover. That's when a company learns and emerges stronger. And then thrive, of course, is where the company prepares and shapes the new normal, evolves, and then is better off in the long term. So I know that it seems far away that we would get into the thrive phase, but it is important to not only think, 2 feet in front of your face. It's important to think from a long-term perspective as well. So before I get into those questions to my panelists, I will remind folks, so we're about 10:06 right now. We'll be presenting until about 11 o'clock. In terms of Q&A, we're going to go through and talk amongst ourselves for about 40 minutes. And then following that, we're going to take questions from the folks who are on the call. And so the way that you can communicate those questions is in your Zoom chat. Just on the bottom, there's a speech bubble. And so you can just put your questions in there, and then we'll go through and read them, and then the panelist that is best equipped to answer those questions will go through and answer them accordingly. So with that, we'll ask a question to our first panelist, Katie, and kick things off. So Katie, why is it important for companies to be thinking about tax in relation to COVID-19?
Yeah, Steve, many companies are facing serious cash crunches right now because of everything that's happening with COVID-19. That, coupled with the depressed values that we're seeing, really has companies and shareholders thinking about what they can do to manage their taxes better, and is there a way to sort of come out of this stronger from an overall perspective of protecting your wealth. Shailene, if you don't mind going ahead to the next slide. I think it's easy to think about tax in 4 buckets when we think about it in relation to COVID. So the first thing is, how do you use this situation to maximize your current cash? There's a couple key things to be thinking about. The first one is the recovery of prepaid taxes. So this is where companies would have paid installments in 2019, and maybe they paid more than what they're ending up owing at the end of the year. So what we're advising all of our clients who are in that situation is get that tax return filed as soon as possible so that you can get back that tax that you prepaid. The second thing is to consider whether or not you have losses in the current year that you could trigger and carry them back to offset taxes paid in previous years. So one example would be if a company or an individual actually had a capital gain in the last 3 years where they paid tax on it, and now this year they've got assets that are have devalued, they could trigger the loss and then carry that back and get back the tax that they had paid in the last 3 years. The third point is accelerating large tax refunds. So the way that this one works for companies that have been profitable historically and now in 2020 are seeing significant losses because of COVID or other issues, at the end of the year, typically when you would prepare your tax return, you have a loss and you could carry it back to earlier years to get a refund of that tax. But the key here is the acceleration of it. So what you're looking to do is find a way to trigger a short year end so that you can get access to that refund faster. The other thing to do for those companies who haven't filed their 2019 tax return yet is look for ways to maximize deductions to reduce the tax that would otherwise be payable. So some of the key things to look at are your accounts receivable balance, for example. If that amount is still on your balance sheet now and you haven't filed your tax return for 2019 yet, there could be a good argument that you're not going to collect that debt. So therefore you could write it off, maximize your deduction, and pay less tax. Another thing to consider is inventory and the valuation of it. And even looking at your fixed assets, and if you've had significant additions in the year, are you sure you've got them in the appropriate class and you're getting the maximum CCA deduction that you're able to claim? Finally, we've got some companies who are looking to the life insurance policies that they have in their corporations, because a number of policies have a component of them that have a cash surrender value to them. And there are different strategies that can be used to get that cash out tax effectively if you need that cash in your business. The second one is how to minimize any outflows going forward. So I'm sure many of you have heard that the government has suspended installment payments. You can defer those payments until September of 2020. So I always tell my clients, first things first, stop making any tax payments right now if you want to minimize your cash outflow. And then also, once the requirement to repay the installments kicks back in again in September, it's really important to stop and say, well, how much do I really have to pay? You don't necessarily have to pay last year's tax divide by 12 and do all the catch-ups, because if you're not going to be as taxable this year, then the amount of installments that you have to pay could be significantly reduced or maybe even nil. I also get my clients to think about what their current compensation strategy is, particularly where there's like an owner-managed business. It may make sense to do a dividend rather than a salary, and that way you have less cash going out of the company, but you can have employees or shareholders in the same after-tax position. There are also other deferral options for compensation. So you could implement a stock option package, or either true stock options or phantom stock units. There are loan strategies that can be used. So there are different things to consider. The third bucket is government funding, and I'll talk a bit more detail about that on the next slide. And then the last one is the long-term planning. And I mentioned this at the onset about protecting wealth of shareholders. And so there's a couple things to think about with the depressed values right now. If a shareholder has done an estate freeze or is looking to do one, now is a really good time because of the decreased values. And then for any companies that have built up significant retained earnings, it's always really good to protect those retained earnings by doing what we call like a creditor proofing dividend, and paying a dividend up to the shareholder, up to a holding company, so that any creditors of the business wouldn't have access to that. And the third point is, to the extent you have a number of intercompany loans, it's really important to secure those loans so that if something does go really bad and the creditors come knocking, that those loans are protected. So I'll go to the next slide now, which is the government funding. And it's just a snapshot. There have been so many programs announced both federally and provincially. So I tried to put it into one snapshot just to give us a sense of what is out there. And I like to break it down into 5 buckets. So the first bucket are those programs and incentives that will help companies improve their cash flow. The second are those ones that actually result in a true savings to a company, either through a subsidy or a credit or some form of grant. The third one is access to financing. The fourth is administrative relief, things that make life a bit easier during these times. And then the last one are those measures that are to help employees. So I won't go through them all. There are so many of them. And Deloitte does have an offering called COVID-19 Concierge. And the way that it works is a company can send an email to our concierge address. And basically you give a little bit of information about where you operate, the size of your business. And then our team will automatically scan to see what other programs could potentially match up with your business. And then you get like a customized report to tell you which ones are applicable to you. But I do want to highlight a few because they are getting a lot of attention and we get a lot of questions about them. So I had already mentioned all the deferral of tax payments. A lot of provinces have also deferred workers' compensation premiums. And in a lot of provinces and municipalities, because in some provinces, property tax is done at the municipality level. So there's been a lot of deferrals of property tax as well. So in general, what I say to most clients is if you're about to make a payment to any sort of government organization, federal, provincial, or municipal, stop and just double check that it is actually still due. Because more chances than not, there may be an opportunity to defer that payment. The other one that is big news is the wage subsidy, the Canada Emergency Wage Subsidy. We all started calling it CEWS just because it's so much easier to say, which is the 75% subsidy of wages paid up to a maximum of $847 a week per employee. And then there's also a temporary business wage subsidy, which is 10% of wages paid. Now the CEWS, you're only eligible for it if you meet the revenue test, which is that your revenues have decreased 15% for March or 30% in April and May. The temporary business wage subsidy doesn't have that revenue test. The other bucket that a lot of people have been taking advantage of is the access to financing one. So there are a number of working capital loans and other types of loans or loan guarantees that have been announced to help companies get access to cash.
Excellent. Thank you, Katie. I think, if you look across industries, there are certainly differences in, how severe this is to the businesses and how long term it appears. So, I think that most businesses are still in this kind of react respond phase, but hopefully with some of the loosening regulations in New Brunswick and some of the positive news, they're starting to think about some of the recover phase and things like that. But I think irrespective of what phase you're in, the emergency wage subsidy is, the hot button item that everyone's interested in. And I do see that the portal to apply is open today. So that's going to be a big deal. I suspect many companies have been working through all of their calculations to determine if they're eligible, how much they'll be able to claim, because it is a substantial line item on the P&L. What are the questions, though, that you're hearing the most from clients as they work through this over the past week or two?
Yeah, there have been tons of questions, Steve, but we do start to see some common themes. So first of all, it was companies working through, do I do this calculation on a standalone legal entity basis? Or for those companies that have multiple entities in a group, should we do it on a consolidated basis? And if we do it on the consolidated basis, like what does that mean, especially in situations where there's not one common shareholder? Because the consolidation test actually depends on affiliated companies. So in some cases, that's a bit of an exercise to work through that. And then there was the question of which prior reference period to use. Do I compare my revenue to last year, or do I do the average of January, February? And then the cash versus accrual method. So there were options in the rules. So first of all, we were sort of helping our clients through that. But as we did, a number of questions start to emerge. And so the first one that we got asked was, is there a maximum limit per employer? Because when the wage subsidy was first announced, the temporary one, the maximum amount was $25,000 per employer. But with the CEWS, there is no maximum limit per employer. There's just the maximum limit of $847 per week for each employee. We also get asked a lot whether or not new businesses would be eligible. So to the extent they had revenue in January and February that they can use as a comparison, then yes, they would be eligible if their revenues have decreased compared to that average. If you're a brand new company with no baseline revenue, unfortunately, you wouldn't be eligible for the CEWS. Another question we get asked a lot, especially when it comes to the consolidated group question, is if you can pick and choose to use consolidated revenue for some entities in the group, but not for all. And that question is no. If you decide to use consolidated revenue and file on that basis, all of the entities in the group must be included, and you have to use the consolidated approach for all of the periods of the program. We get asked a lot that if a company can include investment income in its revenue. And this one is a bit tricky because when the CEWS was first announced, even on the CRA's website where it provided a description of the program, it said income on account of capital was to be excluded. However, when the legislation actually came out, there was no exclusion for income on account of capital, and there was no requirement that the income included had to be active business income. So we interpret this to mean that if you ordinarily are active in an investment type of way, so if you have investment income from working capital, or you're a holding company and you're actively trading investments, then you could actually include investment revenue in your test. And this would also apply if you are earning rents and royalties. Another common question is with respect to commissions and whether or not they should be included in remuneration. And the answer to that is yes, commissions are considered eligible remuneration. The trick with commissions, and it's also, this also applies to bonuses, it actually depends on when the commissions were earned. So when you go to calculate the subsidy, the formula actually looks at pre-crisis or baseline, as it's known, remuneration versus the actual remuneration paid in the claiming period. So the definition for the pre-crisis remuneration or the baseline remuneration is the amount that was actually paid from January 1st to March 15th. Versus eligible remuneration is the remuneration earned during the period. And so the distinction is best described using an example. So let's say someone earned commissions January 1st to March 15th, but those commissions weren't actually paid until after March 15th. So because the definition of pre-crisis says that you include the amounts that were paid, those commissions are not included in your pre-crisis calculation. And then because the definition of eligible remuneration is based on the earnings for that period, because those commissions were paid after March 15th but weren't earned in that period, you exclude them from eligible remuneration, so you don't get to claim the subsidy on them. So that same logic applies for bonuses, and I think a lot of companies are missing that point and they're not backing those numbers out when they're doing their wage subsidy calculation. So I wanted to make sure that we highlighted that on today's call. The other thing that's a bit tricky is people don't have their normal pay periods that are lining up with CRA's claiming periods. But technically you are supposed to match it up. So there's a bit of math that needs to be done. You can't just pick up your payroll reports and run with it. You've actually got to figure out who worked what days and what days fall within the claiming period. So there's a bit of extra work that needs to be done in that respect. Also get asked a lot if payments to non-arm's length employees qualify for the subsidy. So this would be payments to a shareholder or a family member. And yes, they do qualify, but there's a couple key things to keep in mind. That employee, that non-arm's length employee, has to have been on the payroll prior to March 15th. You can't bring a non-arm's length employee on the payroll just to claim the subsidy, and you can't increase their salary in order to get more of a subsidy. So they do qualify, but there's a couple more extra restrictions.
Yeah, makes sense.
I get asked a lot if companies are required to top up and pay the remaining 25% of an individual's normal salary or wages. And the legislation does not require you to. There's nothing in there that says you have to. The government is, of course, strongly encouraging companies to do that to the extent they can. And I also get asked a lot if companies are only eligible to claim it if the revenue decrease can be correlated to COVID-19. So for example, if you were expecting a revenue decrease anyways, maybe you lost a contract or something, are you still eligible to claim it? And the legislation does not have any requirement that your revenue decrease be tied to COVID-19. Clearly, that's why it was put in place, but there is no legislative requirement to show that you have to demonstrate that your revenue decrease is related to COVID-19. You mentioned the portal opens today. That's right, I haven't had a chance to go in and poke around at it yet, but I've been told that anyone who gets their application in today, they expect it will be processed within 5 days and then payments 3 to 5 days after that. So by my math, that's 8 to 10 days when companies should see a deposit in their bank account if they apply today.
Excellent. Thanks, Katie. That's quite comprehensive and not surprising because it's a really big number for a lot of companies. And so I heard if a company is inappropriately doing this, are there some penalties that could be applied, or what would the government do to control?
Yeah, I think the government's been very clear that they expect people to take advantage of this to the extent that it makes sense. And to be honest, they have warned of harsh and severe penalties. It can be up to 225% of the wage subsidy that you claim. So not only do you have to repay it, you also have to pay it. You could also have to pay 225% of the amount that you claimed. And there's even jail time that could be applicable. So it's not something you want to mess around with. You definitely want to take the time, get the numbers right, and don't mess around just to get more of the wage subsidy, because at the end of the day, it wouldn't be worth it.
Yeah. Perfect, good point. And so for those who need any help with this, it is brand new and changes, it seems, daily. But Katie has been plugged in the entire time, working with our national folks on this process. So I think her email is attached to the slide somewhere. Feel free to reach out if you need some help, because it is a pretty complicated thing as the thing moves along. Let's now move over to Brian. And so for those watching Brian at home, you'll see his mugshot here. And then on his video, he's got the COVID beard going, so that way you can do the matchup. That's why he looks a little bit different. But nonetheless, Brian, if you look back over the past few weeks, how have clients that you've been working with changed their actions or evolved as COVID impact increases and continues? Oh, I think you've got to take yourself off mute, Brian.
There we go. Thanks, Steve. Good morning, everyone. Thank you for joining us for the webinar. With regards to your question, yeah, if I look back 8 weeks, the conversations we were having with board of directors, other executive teams were focused around employee safety, business continuity, remote operating models, and reducing discretionary spend. And all of those topics are still important, ongoing, and being refined today. But if I fast track to today, not only do we still have a health pandemic, but now we've got a financial crisis as well. In your framework, you spoke about the respond, the recovery, and the thrive. I would say, although I've had a number of conversations where clients are talking around the new normal and trying to reinvent themselves as we try and work through COVID-19, I would say predominantly most of my conversations are still around how do you optimize the business? And even if I just use the word frankly, survival. And obviously when survival is spoken about, liquidity and cash management are typically top of the agenda. And when I talk about cash management and liquidity, there's a couple of topics that roll into that. The first one would be cash flow forecasting, scenario planning, as Katie's mentioned, some government programs, cost reduction, and then working capital optimization. Those would be the key topics that we're hearing today.
Interesting. Could you give some examples on tactics adopted for scenario planning, cost containment, and working capital optimization?
Sure. Why don't I start with cash flow forecasting first, Steve? I would say to you, if your lender hasn't yet asked for a rolling 13-week cash flow, it's likely to come. Not only are they going to ask for a 13-week cash flow, but they're likely going to be asking for bi-weekly reports around accounts receivable, accounts payable. Those reports are going to highlight the amounts that you've collected, as well as the payments that you've made that were critical to the business. I do have some lenders actually asking now for monthly financials as opposed to quarterly, so that may also be requested. In the conversations that I've had with some of these lenders, there are 2 or 3 things that the lenders are truly focusing on. The first one is better understanding the change in volumes. So if you are saying that your business is going to decrease by 80%, 60%, 40%, they are going to ask, how did you get to that? Do you have some sort of analytics or data behind that to support it? Timing and amounts of any government programs or any other financing, we can expect some questions around that. And then most probably the most important one is around your monthly burn rates and what efforts you've taken to try and reduce those numbers. Those are a couple of practical ideas around the cash flow forecasting. If I think about scenario planning, most of my clients have been asked for 3 scenarios, typically a best case, a middle of the road case, and a worst case scenario. These scenarios we're recommending should be built around using at least 4 key pieces of data. First one being economic data, second one being any industry data, third one being around lessons that we've learned from prior recessions, and the fourth one around if you're seeing any changes in your consumer behavior. In working out your scenarios, what I would advise is that you do a deep dive into your customers, your geographies, your products and your services, prices, and any channels that you're using today, and then prioritizing where to invest your money and where you expect your inflows and outflows to come from. One thing that I have noticed in these scenario plannings is many of our clients are giving some thought to revamping their sales and marketing plans. And obviously, e-commerce has become critical. If I move on to cost reduction, typically we look at cost reduction from two key categories. The first one being payroll and the second one being non-payroll. I'll start with payroll. Straight out of the gate, all of our clients have released any temporary or contract labor. Second one, which sounds pretty obvious, but implementing a hiring freeze and not letting any backfilling. Third one would be about limiting any learning and development programs. There are two sides to look at this. I have seen some clients who are taking the opportunity to actually implement the learning and development so that post-COVID, everyone is ready to operate at 100%, while others on the other side of the corner have taken the chance to actually save the cash. Any increases in bonuses are typically being postponed. And if you are an essential service, with regards to your employees, some of the things that I've seen is, reduced pay. I've seen companies ask anywhere from 20% to 50% in reduced pay. There's been a relook at the weekly hours. So maybe not asking people to do 40 hours, but maybe 20 or 28 hours, staggering of shifts, if that's possible. And then asking your employees to take unpaid leave over a period of anywhere between 4 and 5 months. So those are some of the tactics from a payroll perspective. From a non-payroll perspective, where we've typically started with executives is we've asked them to do an analysis around fixed versus variable costs. So to truly understand where your spend is at. And from a fixed perspective, looking at alternatives to either drive those fixed costs into variable or to eliminate them in entirety. From a variable spend perspective, obviously the first place to start is discretionary spend. I would say to you, most clients, if not all of them, have done a pretty good job in reducing discretionary spend. But then maybe some other areas to think about: sales and marketing. A number of my clients are spending less on sales and marketing and also redirecting it to different channels. So no longer maybe having it on the radio or on paper or in the news, but rather having it redirected online or even some of the TV channels, and specifically the news channels, only because the audience is focused on those areas. Repairs and maintenance is another one where you can look at both sides of the coin. Some organizations are taking this time to actually do the repairs and maintenance so that they're ready post-COVID to operate at 100%, while others are really only repairing and maintaining the assets that are necessary or critical to the current business. And maybe the last one I'll touch on around cost containment is around CapEx. Most of my clients have actually taken the decision to stop any CapEx projects that are over budget or running behind time. And even those that were approved but have not yet been started are again being questioned. And then maybe, Steve, the last area I'll touch on is working capital. I'll start with accounts receivable. What I would say from accounts receivable perspective, if I've seen businesses really cross-train or increase the number of individuals that would be within this function, and it's really just to try and obviously increase collections. A couple of tactics that I've seen, and again, a lot of these may sound like common sense, but it's really just getting back to the basics. The first one is ensure that the process that you have about raising invoices is working. And what do I mean by that? Make sure that no invoice goes out that isn't accurate. And when I say accurate, I mean you've taken into account any credits, you've taken into account any collections, and then following up with the client whether he or she actually received the invoice. This is obviously not going to guarantee payment, but what you're trying to do is reduce the number of excuses that clients or customers are using not to pay. The second one I've seen a fair bit is those clients who offer discounts today are actually offering greater discounts to try and accelerate collections. I've seen discounts anywhere from 10% to 25%. Obviously, 25% is a significant number. So I would caution you around doing the math to see if it makes sense. If you're charging any credit card fees, or you previously were charging credit card fees, this may be an opportunity not to charge that going forward. From a dispute perspective, I would encourage you to try and understand what are these disputes, how often are they occurring, and trying to correct the situation. And it's probably the last two, I should say, in accounts receivable. The first one would be around ensuring that your payment channels are working. I've had a number of clients who provide the option to pay online. However, when you go online and try and make a payment, the system is not working. So do ensure that that's working. If you don't offer credit card, if you have not taken credit cards in the past, maybe this is an option as well. And finally, the last one in accounts receivable would be consider debtor factoring. Again, another option which many of our clients are doing. I'll jump into accounts payable. Here, what I would encourage you, first of all, is ensure that you've got a robust payment plan policy. Ensure that there's no early payments. Payments that are being made to critical operations, and ensure that you're only making payments once you've actually received money in. If I look back at the previous recession, the most common tactic was really just around delaying paying your vendors. I'm not saying that that's not a good idea this time. However, I would encourage you to have the open, transparent conversations with your vendors. The only reason why I say that is, post-COVID, you still need to keep these vendors. You still need to have a relationship. So it's only fair if you keep them in the loop today. And then the third one that I would talk about from an accounts payable perspective is really around supply chain financing or dynamic discounting. A number of the banks out there are still offering these programs, and it is a tactic or a technique which can help you maintain the relationships with your vendors. And then finally, the last one would be around inventory. Obviously, inventory is different for organizations, but a couple of common techniques have been around identifying slow or obsolete stock and selling that at a discount, or putting it on some of these e-auctions could be one. The second one is truly only procuring those raw materials which are necessary for the critical business and which are the profitable SKUs. And then the last one around inventory is just truly having the data necessary or around so that you can identify which SKUs are the most in demand today and focusing your time and effort on those SKUs. So those are a few examples, Steve, that we've seen from clients today.
Excellent, thanks, Brian. I think it's pretty clear there are no silver bullets in here. A lot of actions, a lot of change, a lot of innovation that needs to take place, and they all add up to hopefully the business is surviving. Nothing forces rapid change and innovation quite like a once-in-a-lifetime pandemic, though. And so it is pretty amazing to see what businesses are doing and how quickly they're doing it. Brian, maybe one last question for you. What are your thoughts on what the new normal looks like?
The new normal, sure, the $1 million or the $1 billion question. I've got on the slide on the right-hand side, and some of the areas or focus of those conversations around the new normal include looking at digitization. So a number of my clients today have brick and mortar operations and weren't prepared for an online channel. That has actually been accelerated now. So, digitization, online channel is critical. I think we're going to continue to see a remote workforce. I think about we're currently helping a number of banks who have set up their contact centers remotely. I actually see that those contact centers may actually stay remote. I've seen sales representatives now become visual showrooms, so you no longer need to walk into a brick and mortar or a store to meet with a salesperson. I think the supply chain is most probably going to be one area, Steve, where we're going to see the most significant change. Globalization has worked in the past, but many clients have now seen trying to procure product globally has maybe not been that easy, and they're most probably going to focus again to local suppliers. And then there's probably the last one that I'll mention that's on the list there is around asset optimization. And from that perspective, you know, questioning some of the models, whether you own or you rent or you lease, is definitely going to be something. I can see clients also maybe looking at, do I really need to be vertically integrated? Should I really focus on what I'm good at? So I see some asset optimization in the future as well.
Excellent. Thank you, Brian. So we're sitting at about 10:40, folks. Again, just a reminder, if you've got some specific questions that you'd like any of our experts to tackle, you can just put them in the Zoom chat. Chris has got a few in there, but feel free to add over the next 5 or 10 minutes as well. Prior to getting to the Q&A, I'll let Derek Dempster, who's a partner of mine in Atlantic Canada, leader of our Deloitte private practice, walk through the economic recovery dashboard that Deloitte has designed. In my, when I'm not doing my day job, I'm the incoming chair for the Atlantic Chamber of Commerce, and I know this has gotten a ton of buzz, and people are focused on it quite a bit. So we thought it might be helpful for Derek to just explain to the chamber network and the members of the chamber in Fredericton, you know, what the dashboard is all about and why they might want to check in on it every few days. So Derek, maybe you could just walk us through.
Thanks, Steve. Just a mic check, Steve. Can you hear me?
Loud and clear.
Perfect. Thanks, Steve, for the introduction, and I want to thank the chamber for having us this morning and allowing us to share some thoughts. I'm here to discuss the recovery dashboard that our firm has created. And it's fair to say, you know, an obvious statement is the economic impact of COVID-19. It's obvious, it's been very well documented. Some statistics for those who have not been following all that closely, although I suspect we've all been following closely. The S&P Composite Index in mid-February was 18,000 points. It's somewhere in the range, depending on the day, of 14 to 14,500, which is a 20% drop in a very, very brief period of time. Unemployment has increased to over 10%, and it'll likely be over 11% in the next few days, and it continues to climb. Oil prices have dropped dramatically as crude inventories build and demand drops. Last week, crude futures were actually negative, which is a really difficult thing to comprehend and understand. Governments have responded with massive, unprecedented measures, really targeted towards putting cash in the hands of individuals to create stability and liquidity in the marketplace. And some of those are through corporate measures, which Katie alluded to, in the form of wage subsidies, which ultimately lead to companies retaining employees and continuing to have them on payroll. And others are more direct, right to individuals for those people who are affected by COVID-19 and are unable to work for a number of different reasons. But despite all the doom and gloom, we believe the economy will rebound and better days lie ahead. And we've seen that. I've certainly seen that in the way my conversations have moved in the last number of days and weeks. You know, the initial reaction of our clients was, I wouldn't call it panic, but certainly there were a number of quick, timely decisions that needed to be made in the immediate term And now companies and clients of ours are starting to talk about what are we going to do when the economy starts to return. And so Deloitte has developed this recovery dashboard, and you can see one of the screens when you access the dashboard, and you can see the link to the dashboard in the upper right of the screen now. The dashboard is broken into 4 components, and you can see them on the monitor. The first being health, the second being an artificial intelligence monitor, the third being financial, and the fourth being the economy. Each category has a status, and you can see that the status in each category today is red, and that's been the case since the dashboard was created. And as time goes by, those measures will change and the status will be updated to either yellow or green. Under the health category, the dashboard pulls data on COVID-19 cases diagnosed, the number of cases on that particular day, the percentage increase in new cases, and the number of deaths and fatality rates. And the interesting part about the dashboard is that there's some drop-down boxes and menus that you can select to choose to look at the data a little bit differently, focus in on particular regions, or focus in on particular measures that may be of importance to you. Excuse me. And so right now on the screen, it looks as though we're concentrating on Canada, it looks like to me. But you can go in and you can see, for example, in New Brunswick, you can look at the graph for New Brunswick, which shows a nice flattening of the curve. And obviously in the last number of days, measures in New Brunswick have been relaxed, and we're starting to see an opening of things. We've also seen that in Saskatchewan. The troubling part, if you focus on the US in this dashboard, you'll see that they've not seen a flattening of the curve. You can look at each of the states in Canada, or sorry, in the US, and see how their curve looks. And you can see that their curve is still very much on the incline, which is quite troubling given the fact that Georgia, as you know, and is quite well documented, has started to relax measures in that state, and then there are other states that are doing the same. But you can go in and select different regions to look at. On the artificial intelligence category, it's really an interesting category to look at. It measures consumer and social sentiment, pulls information from social and traditional media sources. It also pulls information on traffic in urban centers. It focuses on airline traffic, and compiles all that information, and you can see the impacts that it has had on traffic patterns, flight patterns, and how people are feeling in general about the pandemic. And what I've seen in the times that I usually spend a few minutes every day looking at the dashboard, you can see how things are starting to become a little bit, people are starting to become a little bit desensitized to the news, and that there's a lot less negative and a lot more neutral measurement. Very few positives still, less than 5% in most cases, but you're starting to see trends in that area. In the financial category, we'll look at things like equity markets, interest rate yield curves, and commodity markets. And you can look at those, and again, there's a number of drop-down menus that you can select to focus in on certain measurements that may be of greater interest to you. And finally, under economic, there's lots of measurements in that category as well, where we look at unemployment rates, retail sales, home sales, manufacturing information, and many, many more. So the purpose of the dashboard is to provide information, to provide a direction of where we are going relative to where we've come, and hopefully over time, what it's going to show, and what it will show over time, is a movement in each of the 4 buckets out of red and up and to the right, I'll call it, in either the yellow or green categories. But certainly it's been our thesis so far that we will not see recovery financially and economically until we see recovery in the health of our communities. And as I said earlier, in New Brunswick, as an example, with the flattening of the curve, the economy is starting to show signs of opening, and that's encouraging for all of us. So I'll stop because we need to have time for some questions. But again, the link to the dashboard is on the right, upper right of the screen, and we encourage you all to use that. And if you have questions as you do, please feel free to reach out to any of us.
Excellent. Thank you, Derek. And again, folks, I would encourage you to take a look at the dashboard. It is quite a fun thing to take a peek at. Maybe just before the Q&A, I'll run through very quickly the 5 tenets of resilient leadership that was published by our own global CEO at Deloitte, and just it's for folks to consider as they continue to navigate these very choppy waters. So the first one is design from the heart and the head. In crisis, the hardest things can be the softest things. Resilient leaders are genuinely, sincerely empathetic, walking compassionately in the shoes of their employees, customers, and their broader ecosystems. Yet resilient leaders must simultaneously take hard, rational line to protect financial performance from the invariable softness that accompanies such disruption. So very important. Number 2, put the mission first. Resilient leaders are skilled at triage, able to stabilize their organizations to meet the crisis at hand while finding opportunities amid difficult constraints. Number 3, aim for speed over elegance. Resilient leaders take decisive action with courage based on imperfect information, knowing that expediency is essential. Number 4, own the narrative. Resilient leaders seize the narrative at the outset, being transparent about current realities, including what they don't know, while also painting a compelling picture of the future that inspires others to persevere. And finally, 5, embrace the long view. Resilient leaders stay focused on the horizon, anticipating the new business models that are likely to emerge and sparking the innovations that will define tomorrow. So with that, that's kind of the final component of our prepared remarks. So what we'll do is we'll go into the Zoom Q&A and take a few questions. Again, folks, if you've got items that you'd like us to cover, feel free to jot them down. So I'll go to the first one that Krista Ross posted. I think this seems to be geared towards you, Katie. So I'll read them off. So 1, are employers able to claim the Qs given they've met the revenue test for employees who are collecting CURB if they are under the 1,000 threshold?
Yeah, that is a good question. And that 1,000 threshold was sort of introduced later after the initial legislation came into play. But my understanding is that to the extent an employee is claiming the CERB, that the employer cannot claim the CEWS for that particular employee. One thing to note, though, is if an employee had been laid off and they applied for it and were collecting it, but then were rehired and received retroactive pay, then the employer can claim the CEWS, but the employee will have to repay the CERB or the CERB that they received.
Okay. The second one, Krista asks, has CERB been adjusted to allow for business owners who have lost their income if that income is paid through dividends?
Yes, so the rules are that an employee is eligible for CERB, among other things, if they had at least $5,000 of income last year. And initially, it wasn't clear what that meant. It said employment income, self-employment income, and a few other benefits. And so there were a lot of people asking about dividends. So the CRA did post something on their website to say that it includes non-eligible dividends. So there are 2 types of dividends that shareholders could receive. If they received a non-eligible dividend, which is basically a dividend that's paid from a company who claims the small business deduction, then it would be considered eligible income.
Okay. And then third one, again, this is for Katie. Also, what about business owners who derive their net pre-tax income as gross income of the business, less expenses, i.e. they don't take a salary?
So one of the other types of income that's eligible is self-employment income. So the extent someone is sort of running their own business and reporting that income and expenses directly on their own personal tax return, that would be considered self-employment income. So that would be eligible for purpose of that $5,000 test.
Okay. Thanks, Katie. Krista, I see you nodding your head. You want to give me a thumbs up if that answers your 3 questions? I think you're muted.
Well, the first question, I'm getting different answers from different companies and different representatives, and I'm hoping that we can get some total clarity on that one, because the $1,000 threshold seems to be a big sticking point for some of our smaller restaurants who brought people back for, you know, limited hours, assuming they were going to be able to claim the 75% of the $1,000.
So I will profess that I haven't spent as much time with the CERB as I have with the SUS and other government programs. So I'm happy to take it away and see if I can get you further clarity in case I have shared something that's incorrect.
Well, Katie, that would be great. We'd love to share that with our members, because it's a question that has come up very strongly in the last few days. Thanks, Katie. Appreciate it.
No problem.
Yeah, certainly this stuff changes daily, Krista. So we'll stay tuned and try to put the most current stuff up there. The next one I think is for Brian, or somewhat of a legal question too, but we can take our best stab at it. Can a business get out of current lease if unable to stay at that location? Possible reasons to get out of the lease: reduced revenue, need to change business layouts to comply with new safety measures. So it's a bit of a legal question, but I think, you know, maybe we could just answer, Brian, or maybe even Derek, you know, what are you seeing out there with clients regarding leases?
I actually am seeing a number of my clients go through this process at the moment, COVID related. And what we've done as a step one is there's been a deferral of rent, first of all, anywhere between 3 and 6 months. In some cases, we're actually looking at potentially leasing the property as well. But to your first point, this is actually sitting with the lawyers on what are the options available. Some of these leases also have penalties in it, which I know my clients cannot afford right now. So again, no simple answer, but initial reaction or take on it has been around deferring rent and having a negotiation with the landlord, Steve.
Thank you, Brian.
Steve, just to add to that, I've seen it in my client base, people who are tenants, companies who are tenants, are beginning to have negotiations with the landlords. I think the thing to keep, it is a legal question first and foremost, and there may very well, as Brian alluded to, be penalties within the lease agreement. However, having said that, from a business standpoint and a negotiation standpoint, it's important to remember that those landlords are going to have to put new tenants in those spaces, which will not be very easy. So their willingness to negotiate in this environment is likely far greater than ever before. So and you know, they're going to want to have a tenant in place for when this economy starts to roll or starts to recover in a considerable way. So I would encourage people to have open, frank conversations with their landlords about your ability to honor the current lease or inability to honor the current lease, and discuss how that looks moving forward, regardless of the legal, you know, the legal implications, because you can always reach agreements, and the agreements may need to move into a new lease agreement from an old.
Mm-hmm. Thank you, Derek. I think the next one might be for you, Derek. So it's from Eric. So could you share your thoughts on new or emerging economic opportunities for New Brunswick business based on A, New Brunswick starting sooner than most, and B, the new economy post-COVID-19? So a bit of a New Brunswick spin to it, but maybe just overall, you know, what are some of the business opportunities that will come from COVID-19?
It's a great question. I mean, it's been amazing to me how companies have pivoted and responded. I think it's important to recognize that the economy is going to be different for a period of time. And, you know, as we all go shopping, it's not, you know, it's not like it used to be. Even when we go to the grocery store, we're in lines, we're standing outside. for a longer period of time. And I think it's important to know that and think through that this is not going to change in the short term, in my opinion. Even when things open up, I think there's going to be measures for a considerable period of time. So for those businesses that have not been open and have not been operating during this period, it's important for them to think about how that is going to impact them and what measures they should be putting in place to make people feel safe about coming into their establishments. Being in China, where the economy's opened up sooner than others, there's been a rebound, but it's not been a spike. It's been a gradual rebound. We've seen retail sales, be a little bit sluggish, I would say. So in terms of new business opportunities, I think, Brian, it was you who alluded to the fact that we're moving into a digital world. We already were. This is going to accelerate that. This is going to put those at an advantage who are already moving in that direction and put those at a disadvantage who weren't. And so I would encourage people on the call to really give thought to their capability to do digital business and expand that if they can, and expand it relatively quickly.
Thank you, Derek. So I see we're almost at time, so I'll take one more question here. Unless, Krista, we can keep going over time, but we'll keep going, and then you just wave at us when we're supposed to be done. So the next one is, how do you see leadership changing from past styles to future leadership styles? So I can tackle that one. And then if my partners want to chime in, feel free as well. So I'd say maybe two comments there. One would be, while companies are in the react and respond phase, there's that old saying, more is less. I think when you're in a crisis, more is more. And so as the leader, the more that you're out there, the more that you're communicating across multiple mechanisms, whether it's social media, email, communication, webinar, phone calls, what have you, that requirement to check in and just apply personal touch to folks is a really meaningful thing. Even within our own firm, we set up very deliberate Zoom coffee chats with pockets of folks. And in particular, these are driven by leaders, and it's just to add that personal connection, because it's very easy to get lost working from home when you're disconnected completely. So I think that's number one. And then in the longer term, I think trust becomes the absolute most important leadership currency. And trust is accretive, but it's also very easy to damage, especially when you've got these very high stakes decisions taking place. And so I think employees will remember how an effective leader handled COVID-19, and they'll also remember how leaders did not effectively deal with COVID-19, and the companies that did it in a positive way and in a transparent way. I think that'll pay off over time. I don't know I think there's a couple of other questions, so why don't we keep rolling? So have you heard or seen any implications to medical, dental, or other affiliated businesses? So I'll just throw that to all three partners. I don't know who would be best equipped to answer that one.
My fast reaction is I've not heard specific implications for those businesses, but I would think those businesses are intimate businesses that require a fair amount of personal interaction. So I think that it's going to be cautious. I do see in the physiotherapy industry, for example, people doing online or some kind of an online treatment. Which is quite a bit different than probably what most people are accustomed to. But it's going to take time for people to feel safe in those environments, I would think.
Yeah. Krista, if you can just give me a thumbs up if we're continuing to keep rolling.
I think what we should probably do is maybe a couple of more questions and then tie it up. And let's aim for maybe 11:10, 11:15. We are recording the session, so we'll be able to share it with our members who weren't able to participate. So that's great. But if you could go ahead and get those last couple of questions in and then tie it up with a close. I'll say my closing remarks now, which is thank you so much. This has been great information. I think it's really important for our members to be thinking ahead and being resilient leaders, and this has been very, very helpful. So
Excellent.
sharing this, and I'll put it back over to you and try to tie it up between 11:10 and 11:15.
Perfect. Thanks, Krista. Okay, so the next one, do you feel temporary pay raises in wages for grocery store employees will remain the new norm, or wage increases for long-term care employees in Ontario transfer to those in New Brunswick? So I guess the concept of COVID-related wage market differentials. And so, Brian, I don't know, maybe that's a good question for you. I see you've got to jump in 2 minutes. So maybe you can just comment on what you're seeing out there.
So initial conversations I've had, because I spend a fair bit of time in the grocery sector, as well as even contract manufacturing and manufacturing environments. And initial thoughts are that these additional wages are going to be the future, only because there's lots of questions around how do you maintain social distancing in the future. These are essential services. So right now, from what I'm hearing, this could be the standard going forward. And you would have seen just recently some of the grocery retailers have actually extended that period for which it relates to, and there are actually some negotiations to further increase it with some of the grocery stores.
Perfect. Thank you, Brian. So I guess you can sign off now if you'd like. Chris, I see that the questions, I believe, are done. So I think we can probably start to wrap up. So thanks very much, folks, for joining this morning. It's always a pleasure to join something resembling a business gathering, which I think we all miss from all the chamber lunches and galas and things like that we all used to shake hands. I guess that may be changed for quite a while. But it is always a great opportunity to come out and see some smiling faces and talk business. If you look to the right, you'll see in the Zoom chat the email addresses of the folks that were speaking today. Feel free to reach out. These things, as I mentioned at the onset, change daily, and so it is important to have all of the most up-to-date information. If you have any questions for us, that is the best way to achieve it. And feel free to take a listen on the Chamber website. As I mentioned, I'm connected quite a bit to the Chamber network, and I'm a big believer. And so I'd like to maybe take this opportunity to thank Chris and her team for all the good work they're doing supporting businesses in Fredericton and in New Brunswick. So with that, Deloitte signing off.
Thanks very much.
Okay, see you guys.